If you are interested in investing in gold and silver, then you may have wondered at some point which is better, buying physical gold and silver coins and bars or buying stocks. They each come with their own set of advantages and disadvantages. If you are considering either physical gold and silver as an investment or stocks as an investment, then you should understand the benefits and risks associated with each. I look forward to exploring that with you in this video. The information in this presentation is taken from publicly available sources and is factual and accurate as of the date of publishing this video unless otherwise cited. All opinions expressed here are for educational purposes and should not be considered advice. All opinions and views in this video are subject to market conditions and may change at any moment for any reason and without notice. You are responsible for your own decisions. Do your due diligence before making any investment of any kind. Full disclosure, I do own physical gold and silver. I do not own any precious metal ETFs, and I do own gold mining stocks. In this video, we will cover investing in physical gold and silver, buying physical gold and silver exchange-traded funds, gold and silver mining equities, central bank swap line agreements, choosing which gold or silver mining company in which to invest, and my preferences in choosing stocks. Investing in physical gold and silver. If you want to invest in physical gold and silver that you hold and keep yourself, then you would buy coins and bars. You can get these online at a reputable dealer, or you can go to a local coin shop. Whatever you choose, when you get it, you get to hold a physical piece of gold or silver in your hand. It is an asset that you can keep physically in your possession and do with it as you please. It is a way for you to have an asset which is a physical store of value. Aside from their aesthetic appeal, gold and silver are very useful metals, and you can save them for use at a later date. Since they are useful, and there are good reasons to think that they will always be useful, saving it and holding it are extremely valuable. There are many different products that you can buy, but this is a whole other discussion, and unless you're an expert, you want to get good recognizable products. There are premiums associated with buying physical gold and silver products. That means that whatever the market price you see on the ticker, your product will cost a certain amount more because the workers at the mint who make the gold or silver coin or bar have to get paid. It's better to pay a lower premium if you can, and there always will be a premium. If you sell a good recognizable coin or bar such as a US Silver Eagle, then you can reasonably expect to get most of the time at least market price for it, though sometimes the dealer or coin shop would be willing to pay more. If you are willing to sell scrap gold like 14 karat gold or scrap silver maybe from silverware, then you may get much less than the market price for it because it might need to go to a refiner. If you sell physical gold and silver like this, then you may be subject to special tax treatment. In the United States, selling physical gold and silver bars and coins is taxed, and this is at the collectibles capital gains rate of 28%. You also need to be aware that you need a safe place to keep it physically, such as a safe or a vault or a safety deposit box. Maybe you would be the kind of person that wants to bury it in a treasure chest like a pirate, but whatever you decide to do, you may want to give some thought to how you store your metals, which could entail some inconvenience. Let's summarize the pros and cons in a way that's easy to remember. Pros: it's a physical asset, it has high liquidity, it's collectible, and it's a good store of value. Cons: it requires storage, it has premiums associated with it, there are higher capital gains, and it is less liquid than other types of investment products. Physical gold and silver exchange-traded funds. If you want to invest in physical gold and silver, then you can simply buy an exchange-traded fund, or ETF for short. Whether you choose physical gold or physical silver, it will work the same way. You buy and sell shares of the fund, and the custodian of the fund is supposed to add or remove the actual physical metal from the vault of the trust. These are audited, and their price is directly related to the physical price of metal on the spot market. There are some good advantages that buying an ETF will have. One of them is that it is highly liquid. You don't need to look for a coin dealer or some other buyer to sell your metal. You can simply go on your brokerage account such as Robinhood and click sell. They are traded at a high volume, so the proceeds will go instantly back into your account. Physical metal ETFs offer an opportunity to gain price exposure to the metals themselves without having to worry about finding a dealer, delivery of the product, or storage. Since these are backed by physical metals and are audited for accuracy, then if the fund goes bust, then you technically have the opportunity to collect a portion of the physical metal in the fund. fund. There are some drawbacks to investing in physical precious metals ETFs, such as the fact that you don't actually own the metal itself, it's held by a custodian. For example, GLD, the largest physical gold ETF in the world, has the custodian HSBC Bank. I understand that it's audited, but the whole value of this security is in the physical metal that it holds, and that relies heavily on the audits being accurate. I don't know about you, but I think that the reason most investors choose to invest in gold is so that they don't have to trust a bank to keep track of it. Since it is a trust, if the fund goes under, then the only holders of the fund that will get any physical gold are the big players and not someone with only a few $1,000s invested. Finally, to top it all off, the gains from physical metal ETFs, at least in the United States, since the fund holds physical metals, are treated as gains on the collectibles rate of the capital gains tax of 28%. Let's summarize the pros and cons in a way that's easy to remember. Pros: it's backed by a physical metal, it's highly liquid, price exposure to the metal if you own the security, and there is no need for storage. Cons: the metal is not actually in your possession, you have to trust that the audit is accurate, delivery of the metals is not guaranteed, and it is a higher rate of tax than the normal capital gains rate in the United States. Gold and silver mining equities, or stocks. One viewer asked me if investing in gold and silver mining stocks is worth it, which is why I'm making this video. The answer is yes, yes, and yes. There are companies that mine gold and silver that are publicly traded, and as a general measure of this, we will look at the Gold Miners ETF, the GDX, and the Top Silver Miners ETF, SIL. The shares of these companies tend to fluctuate with the market, but behave more dramatically. If the price of the metal goes down, then you will see a larger downturn in the share price of the company that mines it, but if the spot price of the metal goes up, then the share price of the company mining it will go up a lot more than what it does for the metal in the spot market. It functions practically like a leveraged bet on the physical metals themselves. Part of the value of the mining companies is tied directly to the metals in the mines it develops, and when you own shares of the company, it's like owning a share of a profitable gold or silver mine. Let's not forget that gold mining companies are literally gold mines. Some advantages of investing in mining companies include higher gains on the physical metals themselves in a bull market. These higher gains and price increases in the market price of physical metals makes the companies more profitable. Those profits are frequently distributed to shareholders in the form of dividends. Since these mining companies are equities, it is easy to sell them to get the money back into your brokerage account, which makes it a highly liquid asset. Furthermore, since these are equities, the gains are treated like the sale of a security in the United States, which is only a 15% capital gains tax rate. Unlike with the other two ways of investing in gold and silver, which I mentioned, gold and silver mining companies have their own set of risks. One is that picking the wrong company is easy. The timeline from discovery until the gold or silver mine produces is around 10 to 15 years. With new products, they don't always work out well. Sometimes the gold that they thought was there is deeper than anticipated, or it's in a different part of the land that they haven't developed, or sometimes it's not there at all. This is a big problem with junior mining companies. These timelines and discovery risks add to the cost incurred by the company. Another important risk factor is the geopolitical situation. Many of the most abundant gold deposits in the world are in geopolitically unstable areas, and this puts a huge risk on the supply chain, which drives up the cost of producing the metal. Most silver is not mined for the sake of mining silver, but rather it is a byproduct of producing zinc, copper, and lead, so a lot of silver mining is not actually silver focused. As mentioned before, the price of a mining company goes up a lot more than the price of the metal when the spot price goes up, but it also goes down a lot more when the price of the metal goes down in the spot market. This makes it a lot easier to lose the principal on your investment because if the company actually goes under, then you, as the stockholder, are left holding the bag. Let's summarize the pros and cons in a way that's easy to remember. Pros: high liquidity, higher upside potential than physical metals. They pay dividends a lot of times. Lower capital gains tax rate in the United States. Cons: picking a good company can be difficult. New mining products can carry high risk of failure. Mining gold entails geopolitical risk. Mining silver is not necessarily silver focused, and the loss on a share price is greater than on the metal, and unlike with a physical precious metal, it can go to zero. Central bank swap line agreements. Before we go any further, I need to explain something called swap lines. The Federal Reserve Bank of the U.S., the bank of the world's reserve currency, has an agreement with other central banks around the world to have swap lines. A currency swap involves the exchange of interest and sometimes of the principal in one currency for the same in another currency. Interest payments are exchanged at fixed dates through the life of the contract. A currency swap line would be an ongoing agreement to do this between central banks. As of March 19, 2020, the Federal Reserve Bank of the United States has had swap lines with central banks of Norway, Australia, Brazil, Denmark, South Korea, Mexico, New Zealand, Singapore, and Sweden. And going back further, as of October 31st, 2013, the Federal Reserve Bank has had swap lines with the central banks of Canada, the UK, Japan, the EU, and Switzerland. Choosing which gold or silver mining company in which to invest. The most interesting strategy I have heard is from famed resource investor Marin Katusa. When he speaks of his successes, he talks about being successful in starting gold mines all across the world. He says that after having gone after gold in parts of the world that are geopolitically risky, there is definitely huge upside potential, but that it is not necessarily worth the risk. According to Katusa, it's better to eliminate the geopolitical risk because the payoff might not be 10 times, but it could only be 2 or 3 times, and with a much higher certainty of success. Therefore, it is better to find mining companies in countries that have swap line agreements with the Federal Reserve because that will remove the risk that can result from another country trying to manipulate the currency or interfere with the exporting of the product produced by the mining companies at the respective mines in those countries, and it's better to find good companies in swap line nations. Katusa shared this chart in early 2020 of gold mining companies and how much of their operations are in countries with swap lines and those without. The two best in this regard are Newmont Mining and Agnico Eagle Mining. Even Barrick Gold, the second largest gold producer in the world, has just under 50% of its product produced in dollar swap line nations. There is also another type of gold or silver producer that makes money off of leasing the land to the miners and then collecting the royalty payments called a royalty company. These companies do not incur the risk of mining the land, but until it's extracted, they sort of own the gold in the land. Marin Katusa had a chart that showed the royalty companies also, but I'm not able to find it now. What I remember from it is that Franco-Nevada did not have all of its land in swap line nations. Cisco Gold operates entirely within swap line nations, and Wheaton Precious Metals has more than half in swap line nations. My preferences in choosing stocks. Taking the swap lines into consideration, these are the companies I like. Newmont Mining is the largest gold producer in the world, and it pays dividends. It pays the best dividends of all the gold and silver mining companies, currently at around 3.8% annually. Barrick Gold is the world's second largest producer of gold. They also pay dividends better than most other gold companies, currently around 1.8% annually. Agnico Eagle Mines operates entirely within swap line nations, and they pay 2.5% in dividends annually. Wheaton Precious Metals mines gold, silver, and copper, and they get exposure to all three of these metals. They operate mostly within dollar swap line nations. They also pay a dividend of around 1.3% annually. It's not listed in the top holdings, but the GDX also has another company that I like that operates entirely within swap line nations, and that is Osisko Gold Corp. They are up over 30% from their lows in 2020, and they pay dividends of about 1.4% annually. I don't have particularly strong opinions on silver mining companies, but if I had to pick some, then I would consider Hecla Mining because it pays dividends, and they have been in business for a very long time. They were established in the 1800s, and they have well-established and developed mines, and they generate a lot of revenue. First Majestic Silver is a relatively new company that's been around for only a few years. I have listened to multiple interviews with their CEO, Keith Neumeyer. I like what he has to say, and I think that he is good management, and that's important when picking a company in which to invest. If you listen to interviews with investors who have been successful in the mining space, such as Marin Katusa and Rick Rule, then you may have heard that when investing in gold and silver stocks, it is essential to consider the management of the company. It's better to find a company where the CEO and other ranking executives of the company have a vested financial interest in the performance of the company. Sometimes startup mining companies are funded and managed by the founder. If the founder has 20% stake in the company, and if that person is also the CEO, then that CEO has a vested financial interest in the success of the company. Many publicly traded companies are led by management teams that receive stock option compensation, and they have no real ownership of the company.
company. Companies where the leader has a vested financial interest tend to outperform in the long term those companies where the leader does not. This is because financial incentive is to protect one's own investment rather than just try to get rich off of the stock options from short-term price gains of the stock. I personally like to look at the balance sheet of a company to determine if it is financially healthy. To do this, it is easy if the company is publicly traded and listed in the US. Go to www.sec.gov, then go to the company filing search, then type in the ticker symbol in the search bar. We will look at Agnico Eagle Mines as an example. You will want to look for the annual report. This is a foreign company, so their annual report is called a 40-F. A lot of times it'll be a 10-K report. You will want to look at the most recent one. After you go to the report, you will want to go down to the index and select Consolidated Financial Statements. Scroll down to Consolidated Balance Sheets. Then look at Total Assets. Then we look at total liabilities. Then we look at total equity. Since assets in general terms is what the company has of value on hand, liabilities are the company's outstanding financial obligations including debt, and equity is what the management team and shareholders own in the company. I like it when a company has a lot more equity than debt. There are many ways to value a company, but discussing that would be a whole other video, and my goal here is to show you that it is very easy to look at a company's financial records. The last thing that I like to look at is whether a company pays a dividend or not. I think that dividends are an important factor to consider when making an investment because I personally believe that an investment should pay you to own it. To illustrate why I like this in a company, I will use a popular dividend stock, ExxonMobil, as an example. In the last 4 quarters, they paid out about $3.48 per share, which is about 6.38% as of the recent share price. But if you had bought it in March or October of 2020, when it was below $32 per share, instead of the near $56 per share that it is now, then that annual dividend payout would be closer to 11% per share of what you invested. This is one possible way to generate passive income. If you want to invest in gold and silver mining stocks, then you should have an exit strategy. I believe that sometime in the future that there will be a mania for precious metals again like there was in the late 1970s, and during that craze the market will peak, and that will be a good time to sell. If I had to guess, a good time to sell would be when you start to see the craze everywhere. When you see GLD and GDX in Robinhood's top 10 most traded, along with maybe a junior silver mining company, then you know that the retail investor is in on it too, and that it may be a good time to sell. Let's summarize that in a way that's easy to remember. When picking a mining stock, you may want to look for company with good management, swap line agreements, higher equity than liabilities on the balance sheet, and you want it to pay dividends. This just about summarizes the way that I look at investing in gold and silver in a general sense, but there are many more things we can say about the subject. For the sake of time, I will not go any further. If you want me to elaborate on anything discussed here, then please let me know in the comments and I will try to address that in a future video. Do your research, have a strategy, be careful. I hope this was informative. Please check back in the future for more videos like this, and thank you very much for watching.